There are 3 key reasons why this bear market seems excruciatingly long and painful. 1. Up until a few years ago, investing wasn't as straightforward as signing up for an account with Robinhood and instantly being able to trade stocks on our cell phones. Since the recent financial technology revolution, a lot more people were able to start investing, and with a lot more people in the financial space and a lot more interest, many of us are newer investors, and we've never actually been through a macro bear market. Keep in mind the last one started back in 2008, almost 15 years ago now. So with more fresh blood in the space, there's just a lot more pain going around. Reason number 2. Our attention spans, much like most of the asset classes over the past year, are completely wrecked. With TikTok, YouTube Shorts, and tweets becoming more popular, we get bored more frequently and can hardly focus on anything for a reasonable amount of time. This market downturn started from the peak back in November of 2021, and it's only been 13 to 14 months now. So we've got more people in the space with shorter attention spans. And reason number 3 is crypto. Since the crypto markets hit the scene, we've gone from Monday through Friday, 9:30 to 4 p.m. US stock market activity to 24/7, 365 global crypto market mania. Crypto constantly moves, never sleeps, and a year in crypto feels like a decade because of it. So we've got more people in the space with shorter attention spans that have gotten used to a cryptocurrency market pace with extreme volatility. So what do we need to do? Well, impatient investors need to remember the lessons of the dot-com bubble. The legendary value investor Benjamin Graham noted that successful investing requires the patience to wait for opportunities that may be spaced years apart. But once those moments arise, it also demands the discipline to stick with them as they unfold over time. That's a crucial point today's investors need to remember. Hello, I'm Crypto Casey, and welcome to another episode of Crypto This Week. Let's take a look at the global news stories and the state of the current macro environment. Please check out our sponsors Proton, Morales Academy, and Ledger. Get a free encrypted email address with Proton to keep your data, privacy, and crypto accounts safe from hackers. Jumpstart your career in the blockchain technology and cryptocurrency space with affordable, beginner-friendly courses and education at Morales Academy. And safely buy, sell, exchange, and store your cryptocurrencies with Ledger hardware wallet devices and their cryptocurrency management ecosystem, Ledger Live. Make sure to scroll down and use the links below to access the correct and official sites and redeem any special offers they have going on. Cool. Besides for patience as newer investors in this most recent macro bear market, other crucial points we need to consider is how we still haven't given the crypto and traditional financial markets time to shake out bad actors from both the bear market and the FTX collapse. This week, leading bank for crypto, Silvergate tumbles as FTX implosion prompts $8.1 billion bank run. Silvergate Capital Corporation shares plunged after the bank said the crypto industry's meltdown triggered a run on deposits, prompting the company to sell assets at a steep loss and fire 40% of its staff. And effects all the way back from Three Arrows Capital going bust are still radiating as crypto lender Genesis considers bankruptcy and lays off 30% of staff. The firm suffered steep losses from loans it supplied to Alameda and Three Arrows. Yikes. And what's worse is how big of a role lack of regulation is playing in crypto fraud and the falling of big dominoes in the space. As a bankruptcy judge says Celsius crypto investors don't own their accounts. A sneaky clause in Celsius's terms and conditions made all investments property of the now defunct crypto trading platform. Though this specific ruling only applies to Celsius, it highlights a much larger issue within the wholly unregulated cryptoverse. Many other platforms have similar terms for account holders as Celsius did and does, Aaron Kaplan, a financial lawyer and crypto company owner, told the Washington Post. Would-be investors need to understand the risks they are taking when depositing their assets into insufficiently regulated platforms, he added. Very disconcerting. This is why it's so important to please make sure you are transferring any cryptocurrency investments sitting on exchanges to your own cold storage hardware wallet like Ledger devices. Ledger's most affordable Nano S Plus device starts at $79. So if you have more than $79 worth of cryptocurrency that you would not be happy about losing if an exchange froze your funds, got hacked, or went bankrupt, make an investment in completely owning and controlling your crypto with Ledger devices. What's great about Ledger versus other competitors is that it has its own robust, easy-to-use Ledger ecosystem that allows us to buy, sell, trade, exchange, and secure our cryptocurrency investments all from the safety of our cold storage hardware wallet devices, which you can check out by clicking on the link above. And make sure to scroll down and access Ledger's correct and official site, as well as redeem any special offers they have going on for us. Sweet. And the FTX collapse, like we've been discussing on the channel, has likely spread to the traditional financial sector, as this week, U.S. regulators warned banks over cryptocurrency risks. U.S. regulators have issued their first ever joint warning to banks over the risks associated with the cryptocurrency market. The watchdogs told financial institutions to be wary of potential fraud, legal uncertainty, and misleading disclosures by digital asset firms. Banks were also cautioned over the contagion risk from the sector. It comes just 2 months after the collapse of trading platform FTX sent shockwaves through the crypto industry. And as U.S. regulators delivered a message to banks, also this week, the Fed delivered a message to the stock market. Big rallies will prolong pain. A line from the minutes of the central bank's December policy meeting, released Wednesday afternoon, was taken by analysts and economists as a warning to financial market participants that bets on a policy pivot in 2023 aren't welcome. And to the extent that equity rallies and other financial market developments loosen overall financial conditions, those wagers will only force the Fed's policy-setting Federal Open Market Committee to prolong the pain necessary to bring down inflation. Like we've been discussing on the channel, the Fed is hellbent on getting inflation down to their 2% target. But if something big breaks, the Fed will have to pump the brakes and pivot. In this video, you can check out by clicking on the link above, we discuss how Cathie Wood is optimistic about our chances of inflation dropping to that 2% level as early as this year due to deflationary pressures and other economic variables. Either way, the Fed does not like markets rallying from bullish news. And this week, we did get some, as the U.S. jobs report breathes life into Fed's soft landing scenario. A jump in the workforce and easing wage growth suggests the U.S. job market is starting to move the way the Federal Reserve had hoped it would, to bring the supply and demand for workers into better balance and help in its battle against inflation. After a year in which many basic metrics of the jobs market stalled at levels the U.S. Central Bank feels are inconsistent with stable prices, employment data for December, published on Friday, brought a hint of relief. So the great debate rages on. Will we drop into a deep, dark recession or even depression in 2023? Or against all odds, will we usher in a new bull market? Let me know what you think in the comments below. We do have at least one bull among bears in the house. This week, our opportunity to accumulate Bitcoin is about to end, says crypto analyst Jason Pizzino. Here's the timeline. We may only have 5 months left of Bitcoin being underneath this MVRV accumulation zone, which in the past has called for some pretty good buy opportunities before the market starts to accumulate at higher prices, like it did in 2015, and again in 2019 and 2020, and then go on to those next bull markets. It can be easy for many investors to be left behind because they're expecting lower and lower prices. But a lot of the data is showing that if we haven't hit that exact price bottom on Bitcoin, we're probably somewhere around it. We want to see whether Bitcoin is going to test those upper prices. First, hit that $18,500 mark. That's going to be a key level. I think if we break that, then we'll probably put in a higher low around that March-April period. But if we don't, if we're unable to get past that $18,500 mark, then we'll probably put in some sort of lower low. Nice. Personally, I'm still optimistic, bullish, and sticking to my random wild prediction of reaching a market bottom around March 25th of this year. And if you haven't yet, check out my video exploring why by clicking on the link above. Awesome. Well, that was Crypto This Week with me, Crypto Casey. If you enjoyed it, please make sure to like the video, subscribe to the channel, and click the bell notification to stay up to date on all of the latest videos. So, how has your first week of 2023 been? Are you ready to increase your income to take full advantage of all the opportunities for the rest of this bear market? Have you transferred your crypto from exchanges to cold storage hardware wallets? Let me know in the comments below. Be safe out there.